Hey guys, welcome to the Mortgage Celebrity Studios. I'm here with Dave Burgio with Trifecta Credit Solutions. I've known Dave for probably, going on two and a half years now.
Yeah.
We met before I started working here. Well, you think so? You think we met here, but we met, and you've always been in this space. The few different things that you do, but credit repair has always been close to what I do because in mortgages we deal with a lot of people who may not qualify because they don't have great credit, or something I want to talk about more today is maybe they have a decent credit score, but I need to get them to the next tier to get them a better interest rate, to qualify for a different loan program, to help them get a bigger house, whatever it may be. So having an expert on like you who's been doing this for some time now is always good to get this information out there. So welcome.
Thank you for having me.
Yeah.
Hello, everybody.
Yeah.
Yeah, man. Let's talk credit and mortgages, man. Yeah.
So obviously, some of your credit repair that you do is going to be with people who don't currently qualify. So what do you see the most of when it comes to credit repair? What are people missing right off the bat? Easy win. Like, what can you do to either get awareness to this or improve your credit? What do you tell people from step one?
Yeah, the two main controllables that I always tell people, and this is the problem I see in the industry. If those of you that really know me, and you and I have had many conversations over the last 2.5 years, the biggest problem that in the industry, and you'll see where this correlates to people and those factors, is controlling your controllables. Nobody in the industry talks about it. They talk about remove this, remove that, get this removed, and all of a sudden your credit report's going to be great. That's a third of the battle. 2/3 of the battle is already what you have and what you control. So that being said, the two most important things that I think that people can help themselves right away is paying down credit card debt. Reason being is revolving trade lines are 30% of your credit score, equates to 165 points. So if across the board, all your trade line accounts, if you're 75% utilized, you're probably losing at least 100 points, probably more than that. So you want to get that paid down as much as possible right away. Everybody in the industry says 30% utilized or less is the sweet spot. I mean, I've tested it out myself over the years. Anything under 10 or below is the sweet spot. So that's the first thing, is paying down as much of that as possible. There's other ways to get rid of that as well. And then the second thing is, if you are currently late on your open and active accounts, stop that.
Yes.
Stop that right now. Because you're going to need, I guess, depending on the mortgage, right, at least 6 consecutive payments or 12 consecutive payments, aka 6 months or 12 months of consecutive payment history. So start paying your stuff on time now. If you're 60 days behind or 90 days behind, you're actually kind of on that borderline of a lot of trouble. So get that current and active right away. Get yourself on auto pay and make sure you're consistently paying that stuff every single month. Because if you're in the hunt for a mortgage right now, you're pretty much already on the sidelines for at least a year, even if your credit is already good.
Well, if you want a bank to believe that you can pay a mortgage payment, don't you think they want to see that you can make a car payment? And don't you think they want to see that you can make a credit card payment? So if you call me and apply, then I see that you're missing your $3,000 more or credit card payment. It's hard for me to justify being like, hey, and I've heard every story, sometimes it's an excuse, sometimes it's a legitimate reason, medical situations, loss of job, loss of family member, incoming bills that they weren't expecting. And I sympathize with all of that. And it's, again, going back to the control what you can control, which is, yeah, these things happen. Sometimes the negative things on credit report are unavoidable, but what do we do from here? And that's where somebody like you comes in. When I have somebody who is really, beyond my advice, you are way more of an expert in this space than I am. I see credit reports all the time. I had no idea the factors that you just gave, that credit utilization is 30% of your credit score. Now, when you say utilization, for those of the people out there that don't know, when you're talking about 70%, 30%, 10%, what exactly do you mean by utilization?
So utilization is two ways, and it's under the credit card trade line. So they call it revolving credit, right? The definition of revolving credit, they think it has to do with interest rates, like revolving interest rate. Technically, what it means is credit cards. They have the ability to give yourself a loan over and over and over again from going through the process or underwriting process one single time. Okay.
Mm-hmm.
There's nothing else that does that. So, in other words, once you get approved for that credit card, you essentially could give yourself a loan every single month, barring that company still exists, barring that you're still in good standing.
Yeah.
And then the last thing is barring that you have that available credit. So if that, for round numbers, if that card is $10,000, right, and if you have a $5,000 balance, well, you still have availability on that. So going back to percentage, take that same example. You have that one card, $10,000, you owe $5,000, right? Even if you're going to pay it off in full, that statement closes, it's going to show in your credit report, hey, you have a $5,000 balance. Now it's going to put you at 50%. Therefore, being revolving credit, for every dollar you borrow, right? Not spend. Everybody thinks of spending. You're borrowing essentially, right? So for every dollar you borrow, you're going to be a percentage utilized. Your score is going to drop a little bit because now you look like a risk assessment. Why? Because it's the same open and active loan. Basically, with all those factors I just said, as long as everything's there, you pretty much have it forever, right? Unless you die, right?
Yeah. Or you don't use it and they close it or whatever.
Yep. Bank closes.
Which is a big impact on a credit report because of, age of accounts.
Mm-hmm.
If you have a old credit card that you had from college, even though it's $1,000, if it closes because you don't use it, that negatively impacts your score.
100%.
But going back to what you said with the 50% utilization and paying off the credit card. So if somebody pays off their credit card every month, it still shows on their credit report, depending on the time of month that they pay it off, that they didn't pay it off every month. So essentially, you pay it off on the 31st. That doesn't mean it's not going to show up on your credit report, right?
Well, there's two differences. And I always say it's really easy to get confused on this, so don't get caught in the weeds unless you're getting ready to apply for something. I always say the easiest thing is, look, pay the stuff down, pay it off, and don't use it for the next 60, 90 days, whenever your closing date is, or whenever you're going to get pre-approved. And then by the time you get to the closing table, just put that stuff down. Like, if you're responsible and if you have discipline, right? A lot of people are doing this for either cash back or for reward points. They just use it every month, pay it off in full. And some don't, they carry balances. But if you're getting ready for some type of purchase, home purchase, something to do with a mortgage, put that on ice. And the reason being is there's two different dates on a credit report. Even for installment loans, right? Like, you have the statement date, that's when the statement closes, or that cycle. Take credit cards, for example, obviously, because what we're talking about, and then it rolls on to the next month, right? So credit reports are usually a month behind anyway. We're in May. So April's data is starting to catch up. The stuff's never in real time. And I think with the technology we have, we should be
kind of crazy.
Yeah, we should be able to have this in real time. Everything in the credit space is always 30 days, 30 days, 30 days. Or what is that reporting date? So going back to the statement date, if your statement closes on the 10th of the month, right? And then you go in what's called your due date cycle. So you have that 21 or 25 day period of when you owe the money. So the statement date is actually what's getting reported to the credit report. So if you have that $5,000 balance, statement closes on the 10th, say it's due, the 1st of the month. Okay. Once you get it paid off, and if you don't use it, it will report to zero. Now, if you want to beat that, okay, if your statement date closes on the 10th, and some people try to manipulate this. There's a client of ours, he's just having a hard time timing it, and he's losing his mind. And thinks it's something we did. And I'm like, listen, man, you're timing this wrong. And it's like, if you stop using it, then stop using it.
Yeah, if you're also not probably looking at the big picture, which is stop trying to game the system. If you're looking to really have a good utilization, just pay it down, like you said, and don't use it for a month or two.
Yeah, exactly. So if you're trying to beat this, because there's no rule that says you have to wait until the statement closes, right?
Yeah.
So if your statement closes on the 10th and the first of the month comes, it's like, all right, well, I'm going to pay that $5,000 off. The reporting statement closes on the 10th, and the reporting date to the credit bureaus is on the 10th. So by the time it cycles through, the payment post to the credit card company, they'll see it goes through this hand, that hand, and then they report it to the bureaus. It will show as a zero balance, right? I just confused myself basically just saying that, but that's how it works. And like, you can see how people get tripped up on that, especially if they're in a home buying process. Like, all right, I'm trying to game the system. I'm trying to time this. Or I have a reminder here. Or I've set auto pay on the first in the middle of a billing cycle. I mean, if you want to do it, do it. But I think sometimes that can create more headaches.
Yeah, and a lot of times the people who pay off their cards at the end of every month are typically the more disciplined, clients that I have. They are trying to get the rewards points. They're trying to get the miles. They're trying to get the benefits of having the black card. And it's fine. But when they call me and they have a 780 credit score and they're trying to get to an 800, the conversation isn't, what they should be doing. It's more like, hey, you have good credit now. The 800 versus 780 isn't really going to give you an impact on interest rate, what you qualify for. But those people, they have a good credit score for a reason, because they pay attention to the details, right? And so they're already doing the right things. Some of the people that I want to help with this video are the people who are like 680 to 720, somewhere in there. They're maybe young. Maybe they had a couple credit cards in college. Maybe they had a late payment during that college time. Maybe they just don't have a ton of history, because that's a lot of the piece of it.
Yeah. Nobody talks about that.
No. What can people do to maybe get from that 680 to a 740 plus? There's no quick fix, but kind of quickly.
Yeah. Add more credit. Plain and simple. Like if you're at 680 or right at 700, it's not bad, right? Like, you'll still get approved for a lot of things, but if you want that top tier, I always say your mail dictates kind of where you stand.
That's true.
So if you're getting this offer, this 0% offer for 2 years, right? You're getting 10 grand limits. You're getting 20 grand limits. If you own a business and you're getting a bunch of business credit cards on top of that, because they're all personal guarantored as well. So what that mail looks like kind of dictates where you're at, because those are all pre-screened offers. So they're doing soft checks on your credit report to see where you're at. But again, the industry, the gift and the curse. What I don't like about it is a lot of people in my space, they don't talk about building, right? They don't talk about a foundation. They don't talk about mixed accounts or mixed use. I think the biggest thing that I've seen a lot for young people is, if they do have maybe one credit card account, the limit's probably small.
Yeah.
$400. Out of a $500 limit, that's not a lot in the grand scheme of things. I'm like, I pay it off in full every month, but my credit's trash. Well, okay, you're pretty much maxed out on paper, right? Like, I'd rather have $400 that I owe than 40 grand. You know what I mean? So that's the one thing, and going back to utilization, there's two sides of it, right? You have it individually, because we talk about one card, but also it's kind of combined, right? So they're going to look at it, that percentage of utilization individually and also combined. So this is where building more credit comes in. Obviously, a situation like that, pay it off, stop using it, let your credit reflect. If you are getting good offers in the mail, start looking at them. And this is the other thing, everybody's always fixated on an interest rate on a credit card when it comes in. Oh, it's 25%. Oh, it's 29. Which one I should get? Listen, man, they're all terrible.
Yeah.
They're all terrible. But also, my question to you is mentality. Why do you want to hold a balance? There's no rule that says you have to hold a balance.
Yes.
So, like, why are you worried about the interest rate?
Yeah.
You're here to build credit. You're not here to go on a shopping spree and use this thing like Affirm or Klarna or something.
Yeah.
Which, that's a different conversation in and of itself, too. So stop worrying about the interest rate. Really, if you want to get into the weeds, get some with cash back, get some with points. But if you're building, my rule of thumb is at least 3, but you should have at least 5 open and active accounts. That could be a combination of credit card. You should have credit cards anyway. It's non-negotiable. I don't care if it's secured or unsecured. Maybe one authorized trade line in there for whatever, but you still got to have your own stuff, right? Definitely, because you're losing, that's 30% of your credit score is a credit card. So definitely that. If you have an auto loan, great. Student loans, a lot of people overlook that. That's still an installment piece, right? That's going to help you out. I guess mortgage underwriting, that depends, but we have some, what they look at. But we do have a partnership for rent reporting that does report as a mortgage trader.
That helps.
Yeah, 100%. It's going to help. It's going to help the score. I don't know if that will help you get a mortgage, depending on what underwriting.
Well, if it helps the score,
sure.
I mean, that really helps. Mortgage underwriting doesn't look in depth into like everything that's reporting. They don't like disputes.
Yeah.
Disputes remove, and we can talk about that. But disputes are a no. But everything else, as long as the score is good, they're not going to go too much into it. And collections, charge-offs, also, we're going to look at those things. But yeah, to answer your question, no. I mean, as long as the score is good, if rent's on there, that helps.
Yeah, and some people have this, misnomer or whatever you want to call it, that, oh, well, it's a rent on there, it's DTI. Like, well, okay, they're going to pull your checking account anyway, so you're going to see what's coming in and out, like on bank statements. So what difference does it make?
There's so many people that are fixated on debt to income ratio.
Yeah.
Debt to income ratio has 0% effect on your interest rate. It has everything to do with how much you're able to borrow, how much you're able to get as far as the loan goes, but you don't know that until you apply.
Right.
And people always like reach out to me like, oh, my debt to income ratio, I'm concerned about it. And they go through this like circle of like explaining to me why they're concerned. And I'm like, let's just look at it. Like, what's the harm in looking at all this and giving you advice? And, on paper, it may look good, but that's not a really good excuse not to move forward with something or to add it to your credit report.
Yeah. I get so many people that ask me about that all the time. And I said, listen, that's not a factor for what I do. There are doors, right? I call it doors to getting approved, right? First door is score. Second door is what does the data say? And then the third door is what's negative and what's positive, right? So I'll explain doors, but as far as debt to income ratio, I'm like, listen, that doesn't affect what I do. I said, I don't want or need your bank statements. I don't need your tax returns. That's for you, right? Like that would be for like Kyle, right? Like I don't need any of that stuff. That doesn't affect me.
Yeah.
I'll explain a little bit what it means, but I don't know your situation, and I'm not pre-underwriting this deal for you. So.
And part of that is, when I get somebody who needs some credit assistance and I send them over, I've already told them like, hey, this is where you're going to qualify for once your score gets up to this number. So if you go out and get an auto loan, if you go out and get these other things, that's going to be affected. But
don't do that.
If you do, and I know you wouldn't, but if you do get a credit card, with this, and I hear this, well, I'm afraid I'm going to use it. Well, then you probably, which one do you want to have? Do you want to have the good credit score, or do you want to not have a credit card? Because like you can't have both. You kind of need to use the system.
Yeah, and one of the things that we've really honed into our culture, to our core values, is to really explain and educate how this stuff works, right? In general, it's not just come in and, hey, you got a bunch of negative stuff, get that fixed. No, let's build with what you have, rebuild. And then this is how it works moving forward, right? I take it for granted from doing this for basically a decade, right? Like doing this on the side for 4 or 5 years. Trifecta, we started 6 years ago, officially. So, I take it for granted how much people don't know. And it's like, oh, I have these credit cards. Like, I got to use them all the time. I got to hold a balance. I'm like, no, you're just paying interest. Well, I got to use them all the time. Nah, I use them once every 6 months. Yeah, in the beginning, use it a little bit, but, once every 6 months or a year to keep it open and active. Oh, okay, that's it. Yeah, but just make sure you pay it on time. Like, that's it, or pay it off, So we kind of hold their hand or explain it to them and kind of have them, like, explain it to us so it sticks a little bit.
Yeah.
Like, hey, this is the game plan moving forward, because we can't do every single thing for that.
And there's also there's not like a quick fix, especially when somebody has really negative stuff on their credit report. It's a daunting hill to climb. And you go and you look at the situation and you see all the collections, the charge-offs, and they just don't know where to start. And starting with someone like you you have somebody in your corner explaining the exact things. Now, you're not going to tell them, we'll be good in 3 months, because it's not the truth. It's going to take time. But if you don't start today, it's going to take even longer.
Yeah. But there are people out there that will tell you that. There are people out there that will tell you 30 days, right? Or even 7 days. And does it exist? Yes. Is it legal? No. So, so I just want to make that very clear because there's a lot of goofy stuff out there. I had this conversation yesterday with a business colleague of mine. We were talking about the industry as a whole, like what it looks like on both sides, because there's a lot of people in the credit space that do it for the wrong things, give wrong expectations to make money and so forth. And then you look at the regulatory side, right? Like this is supposed to be regulated towards the credit bureaus and so forth. And, you know, they're separate entities and they're businesses. They have no affiliation to the government. They have no affiliation to the FDIC, to Fannie Mae, like no affiliation. Experian, TransUnion, Equifax, they are private entities.
Mm-hmm.
They're just data furnishers. And they don't even follow the rules,
No.
right? So it's, in my opinion, both sides, and this is where we come in and you know, core value, do the right thing 100% of the time, all the time, right? Because on the credit side, they're in it for the wrong reasons. Oh, I'll get your credit fixed in 7 days. That's nonsense. And then on the bureau side, oh, okay, we're just going to ignore your dispute. Oh, okay, even though like you have a valid claim here, sure, we're not going to remove it, you know, until you give them some type of legal notice, and then they start moving, and then they get sued all the time for class action lawsuits because they're in it for the money too.
And they're not a government entity. You said that, and I don't think enough people know that. Like,
no, they're not.
How do they make their money? And if you look
Data.
at it, they sell your data.
Mm-hmm.
How do you think you get a credit card notice in the mail? It's not because this company looked into you. They bought your data from the credit bureaus, and they know you're of a certain credit score, of a certain income that you self-reported, and of a certain, you know, job, and then they send you this offer in the mail. There's a reason business owners get business credit cards, personal people, or like, you know, regular consumers get personal credit card offers. It's because these companies sell your data. They don't care about you. So having someone, again, like you on their side helps you navigate this process. Good luck trying to call Experian on your own to get something taken care of, a disputed account, you know, whatever it is, you know, because you're not going to get it without, you may, but without professional representation, it's going to be a lot harder.
Yeah. Well, the problem with that too is if you can call on your own, and there's some things that obviously, you know, if we can't do, either you need a power of attorney.
You're going to need, they're going to need to
Right.
take that step to call them,
Right.
of course, but
Yeah. But the problem is does it get done afterwards? They're usually, actually not usually, they are. They're call centers overseas, right? So they're not even here. I'm pretty sure Experience home office is in England. So there's that. So call center overseas. What else? If you do like either put your dispute in or have a change, or here we go, we're talking about dispute remarks. That's the quickest way to do it, is to call them. And then it's okay, well, we can have it done in 48 to 72 hours. And then it doesn't happen. Right. So that's the problem. Again, there's no accountability, right? And it's all about the money. So
speaking of disputes, so mortgage companies, you know, what happens when you dispute an account is my understanding is it gets removed from the algorithm as far as how it's factored into the credit score until the dispute is resolved. So when we pull a credit report, if we see multiple disputes, that person could have a 700 credit score, but before those disputes were put on there, that person's score was actually a lot less. And then when the dispute is removed, we noticeably see a change in the credit score. Yeah. So underwriting doesn't like to see, there's specific guidelines, FHA, conventional, they have guidelines as far as how many disputes you can have, what the balances of those disputes can be in order for us to be able to move forward. So just a word to the wise out there, if you are applying for a mortgage and you think that disputing the account is going to remove it, it doesn't remove it. It temporarily removes it from the scoring model, but we still have to wait for that dispute to be resolved for it to have a long-lasting impact on your credit report, right?
Yeah. It's that's so crazy because there's so many people that even our own clients that don't heed our advice It's like, listen, like don't go applying for stuff yet. You're in the middle of a dispute. Like if you're done, we're not gonna send out another one. There's a difference, and I always explain this too to people. Like there's a difference between dispute remarks on there. It'll say, hey, wasn't dispute resolved, whatever, moving forward, and then being in the middle of a dispute. Being in the middle of a dispute, obviously you don't want to do it. You're always going to get one or two that, hey, maybe I'll go apply for this, or always the crazy one, I'll go buy a car, like in the middle of trying to get approved for a mortgage. And it's like, yeah, what are you doing? Like stop that.
Yeah.
You're just,
what sort of disputes go in the person's favor do you typically see?
It's all based on data, man. And if anybody tells you any different, then they're lying. Like it's just flat out. There's no secret sauce. There's no.
What do you mean by
hack.
that?
It's all based on law, on consumer law. So you have the Fair Credit Reporting Act, and then you have the Fair Debt Collection Practices Act, and those are the two main things. But the tie to pretty much come down to what the three basic ways to keep the FCRA very simple. It's based on three things. Is that account able to be, depending on the type of account, whether it's original, creditor, or collection, is it able to be verified or validated? Is the data accurate and complete across all three bureaus? And is it either outdated or within that 7-year window of negative items being on there? So those are the three main things. And then you have all the sub laws beyond that, based on how it's reported, where are you getting this information, can you provide it? And those are pretty much the three main things.
Okay.
Could you get into the weeds on how it's reported, how it gets sent from the furnisher to the credit bureaus? Sure. But that's also has to do with accuracy.
Yeah.
And that's where the whole quote unquote secret sauce comes from. It's not secret sauce. It's the law.
Yeah.
So
another question I have is, I get this all the time.
Mm-hmm.
Somebody has negative credit history, open collections, open charge-offs that still have a balance,
mm-hmm.
or, maybe they're paid off, but I want to focus on the ones that have a balance currently.
Yeah.
It was 4 or 5 years ago.
Mm-hmm.
They have a charge-off. They call me, they say, but that's about to drop off in 2 years. Is that correct?
Yeah, it will drop off. And people, and people also kind of have this falsity, like let's say too, that a lot of people are like, even if you dispute in the window and if you get it removed before then. But yeah, 7 years from the date of when that started becoming derogatory.
Even if it still has a balance.
Correct. Yeah, legally, because it can't be on the credit report. Now, this is what I'm saying, the misinformation. Yes, it can fall off, but that doesn't mean that the debt still doesn't exist.
Yeah.
I know somebody that defaulted American Express one time, I think 20 grand. And yeah, it fell off their report, didn't know it, and they tried to go back to American Express 15 or 20 years later, and it got declined because of that debt. Right now, legally, they don't have to pay it. Right. I'm sure if American Express would allow you back in, I'm sure they want something for it, and they know that.
Yeah.
But the debt doesn't go away necessarily. There's two things: 7 years on a credit report, and in Pennsylvania, right, this varies state to state, but in Pennsylvania, there's a 4-year window. There's a 4-year statute of limitations to where a creditor can legally collect on that debt.
The same creditor or a new creditor?
No, the same creditor. So it goes by the original creditor. So if XYZ collection agency overtook it 2 years later, it still goes back to the original creditor. So just because it either got represented or sold to a collection agency, it doesn't start that clock over.
Now, federally, does it start the clock over? So let me give you an example. We have a debt. It's been owed for 6 years.
Mm-hmm.
A new collection agency buys that debt at the year 6 mark. So it shows up as a new trade line under, now this wouldn't happen very often, but it shows up as a new trade line under the person's credit report. Does that restart the 7-year thing?
Well, depending on when that date would start on there, and this is where collection agencies they kind of get tripped up a little bit, because there's still Fair Debt Collection Practices Act stuff going on there. Usually, and here's the other thing too: if a collection agency owns a debt, they don't necessarily have to put it on the credit report. Now, there's usually a time window. If they assume the debt, they have to wait 90 days. Sometimes they'll wait 6 months and then put it on there. You'll see the dates kind of vary. They'll try to pull some slick stuff. But if you have the original creditor on there, and if they know it's to that, you could cross-reference to that. Obviously, it's inaccurate. Could be a removal. Could be an FDCPA violation. But they get some. Like I said, these guys break the rules all the time.
Yeah.
They're not playing fair either. But could it, depending on what they put that date of last activity on, like if this company charged it off in 2024, right? And then all of a sudden these guys decided to put it on and say they pulled something slick 2025. Sure, yeah, we'll go from the date of 2025.
Yeah.
Is it right or accurate? No, it's not.
And a lot of people are under the assumption that a collection agency is paid for by the original creditor to collect that debt, and that's not the case. In my understanding, that the collection agency buys the debt from the original creditor in most cases for pennies on the dollar, and then tries to collect what they can of that debt, knowing that they can't always collect the full balance.
Yeah, I mean, actually, it does go both ways, right? So they don't necessarily have to buy the debt. They could represent the company, right, and make collection attempts for them. The company would obviously, pay them contingency fee or something like that, or they could assume the whole debt. So it's really up to them. It's up to the original creditor. Yeah, they do buy it for pennies on the dollar. Even if you settle out, obviously, they're still making money. Otherwise, they wouldn't have taken the deal anyway.
Yeah.
So yeah, it could go both ways.
Okay. Well, I could talk about this for like days because I see all these different scenarios, and I can tell you're just a wealth of knowledge. You taught me a lot that I didn't already know. So I think we need to do a couple installments of this to kind of go into more stuff. Like we didn't even touch on like charge-offs and what we can do with those and how those affect your credit. So I want to put a pin in that and talk about that a different time. But where can people find you if they're looking for credit assistance, credit help, credit advice?
Yeah, you can find us on our website, trifectacreditsolutions.com. We're actually right down the street from here, right at 4536 Hamilton Boulevard, right up by Sioka Subaru. You can reach us toll-free, 844-342-6669, which stands for FICO Now. Yeah.
I don't know how you got that one.
Yeah, right. You can, or you can email me directly, Dave at trifectacreditsolutions.com.
And follow Dave on Instagram and Facebook because he's a good follow, always doing stuff. So in the Mortgage Celebrity Studio, we want to thank Dave for coming. We're going to have him back. We thank you guys for watching. Like, subscribe. We'll talk to you again soon.